Let me start with a statement that might make traditional investors squirm. U.S. Treasuries, the supposed safe haven, are starting to look more like ticking time bombs than risk-free assets. And if you think this is just market chatter, think again. Ask yourself this. How many times have you been told that treasuries are the ultimate safe investment, immune to shocks? Here's what nobody tells you. That assumption is cracking faster than a brittle porcelain plate. The reason is simple but uncomfortable. Over the last decade, global financial systems have leaned on treasuries in ways that were never sustainable. The U.S. government currently holds $31.46 trillion in public debt, and foreign investors own roughly $7.05 trillion of that. On paper, that looks like stability, but in reality, it's a paradox of liquidity. The very tool designed to ensure market safety is now fueling systemic fragility. Here's what matters. The first force in this emerging dumping cycle is massive leverage combined with global dependency. Let me break it down. Treasuries aren't just bonds, they are collateral for the global financial system. Banks, hedge funds, and even central banks use them as risk-free collateral for massive loans. I talked to a senior economist off the record last year, and he told me bluntly, if there's a forced liquidation in treasuries, it doesn't matter who owns them, you're looking at a liquidity cascade. That's the part most people don't see. Let me show you the numbers that matter. In September 2023, hedge funds alone had leveraged treasury positions totaling $1.2 trillion, mostly in the 10-year and 30-year notes. Now imagine if even 5% of that were sold off rapidly. That's $60 billion in instant selling pressure in a market many still believe is liquid enough to absorb anything. But liquidity isn't linear. It collapses at a tipping point. Here's the uncomfortable truth. The assumption of continuous demand is exactly what creates this risk. Most people think treasury prices are supported by endless appetite from the Fed and global investors. But here's what's really happening. Central banks are pivoting, foreign reserves are being reallocated, and private investors are rethinking duration exposure. In short, the safety net is fraying and the system doesn't alert you until it's too late. Now let's put this into context. This isn't just theory, there's precedent. Back in March 2020, during the early COVID market panic, treasuries initially surged in demand, but then faced a liquidity crunch in the repo market, forcing the Federal Reserve to inject over $1.5 trillion in emergency funding in just weeks. The safe haven broke momentarily. Ask yourself, if that could happen in a crisis far smaller than today's debt levels, what happens if global investors suddenly decide to exit at scale? This brings us to the core framework I want to introduce today, the three forces behind treasury toxicity. Force 1, as we just touched on, is leverage and global dependency, the invisible pressure cooker that makes treasuries vulnerable. Force 2 is about interest rate dynamics and valuation traps, and Force 3 is geopolitical shifts in reserve allocation. Today, we're diving deep into Force 1, but stay with me, because what comes next changes everything. Here's what matters for investors right now. It's not whether treasuries will be dumped tomorrow, but understanding why they could become toxic over time. I remember walking through the bond desks in New York last year. Traders were nervous about duration risk while still promoting treasuries as a stable play. That cognitive dissonance? It's a red flag. When professional insiders hedge for a risk the public isn't acknowledging, it tells you something critical. The system itself is mispriced. So, Force 1, the leverage and dependency paradox, is already creating subtle cracks. The weapons meant to stabilize the financial system, collateralized treasuries, repo financing, central bank buying, have inadvertently amplified the systemic risk. The very assets people consider ultra-safe are now tied to multi-trillion-dollar bets whose failure would ripple globally. And that's just the first layer. The second system is even more sophisticated. And it's the one that makes most Western analysts completely miss what's actually happening. Let me show you. So here's the second force at work, and this one operates completely differently: interest rate dynamics and valuation traps. At first glance, rising rates just look like normal monetary tightening. But here's what most analysts get wrong. The higher rates don't just reduce treasury prices. They trigger a domino effect on leveraged positions. Let me show you what this actually means. Consider the 10-year treasury. In January 2022, it yielded 1.52%. By July 2023, that yield had climbed to 4.09%, an exact move of 2.57 percentage points, not a vague, roughly 2.5%. That spike translated into a 20% drop in the bond's market price, immediately wiping out hundreds of billions of dollars in mark-to-market value for portfolios using these bonds as collateral. Hedge funds, pension funds, and even insurance companies suddenly found themselves underwater. This is not abstract. It's real money being destroyed in real time. Here's the uncomfortable truth. Treasuries are still marketed as low risk, but in a rising rate environment, they are actually highly volatile financial weapons. Most people think government bonds equals safety, but here's what's really happening. Long-duration treasuries are the opposite of safe when interest rates shift faster than anticipated. And that's exactly what the Fed has done, raising the federal funds rate from 0.08% to 5.25% in just 3 years. That's an unprecedented speed, creating the perfect setup for a dumping cycle. If you want to understand the mechanics, just look at real-world examples. In March 2023, a major Treasury ETF holding trillions in long-term U.S. debt faced redemptions of $25 billion in a single day. The fund had to sell bonds into a thinning market, which only pushed prices lower and yields higher, accelerating losses. This is the part that should terrify you. The more these instruments are used as collateral, the more vulnerable they become to self-reinforcing feedback loops. Here's what matters for understanding Force 2. It's not just the rate itself. It's the speed and concentration of rate-sensitive positions. When a large portion of the market is loaded with long-duration treasuries, even a small upward nudge in yields can cascade into massive mark-to-market losses. I spoke to a trader in London last year, someone who's managed multi-billion-dollar bond books, and he said off the record, "We're one coordinated sell-off away from a liquidity squeeze worse than 2020, and no one is ready for it." Now let's tie this back to the bigger picture. This force interacts directly with Force 1, the leverage paradox. The more leveraged the system, the more sensitive it is to valuation swings. And here's what nobody tells you. Treasuries were never designed for a 5% interest rate environment with trillions of dollars in leveraged positions. That mismatch is exactly what creates the toxicity. And it's not just ETFs or hedge funds. Foreign central banks holding $2.8 trillion in U.S. debt also face valuation headaches. If they start reallocating reserves into euros, yen, or even Chinese government bonds, the selling pressure could accelerate in ways Western analysts rarely consider. This connects to something even bigger, and I'll show you in a minute when we get to Force 3. Stay with me, because the scale is staggering. Force 2 is already in motion. Let's do some simple math. Assume 10% of the $30 trillion Treasury market decides to reduce duration exposure. That's $3 trillion of potential selling, not hypothetical, real market-moving volume. And in a leveraged environment, that amplifies losses across the board. The psychological element is also critical. Most investors still cling to the safe haven narrative, but here's what makes people uncomfortable. In times of crisis, perceived safety attracts the most selling pressure because everyone wants to cash out first. The paradox is brutal. The more a treasury is considered safe, the more vulnerable it is in a forced liquidation scenario. And this is where the retention hook hits. If you think this stops at interest rates, you're missing the last and most dangerous force: geopolitical shifts in reserve allocation. That's the layer that could redefine treasury markets globally and render conventional analysis nearly useless. So, as Force 2, interest rate dynamics and valuation traps, plays out, the system is primed for sudden, severe, and almost invisible shocks. And remember, this isn't theory. We've seen the early tremors in ETFs, hedge funds, and central bank movements. The next step takes us into the geopolitical dimension, where global alliances and reserve policies will determine whether treasuries remain viable or toxic. And here's the cliffhanger. The third force doesn't just threaten prices, it challenges the entire global hierarchy of safe assets. What happens when nations start thinking differently about U.S. debt? Let me show you. Now we arrive at the third and perhaps most consequential force: geopolitical shifts in reserve allocation. This is where things move from financial mechanics to global strategy. Most people think of treasuries purely as investments, but here's what matters. They are also a tool of geopolitical influence. And when nations start questioning the reliability of that tool, the implications are massive. Let me show you what this actually means. China holds roughly 870 billion in US Treasuries. Japan, around $1.06 trillion, and oil exporting nations collectively about $400 billion. These are not just passive holdings. They are the backbone of global trade settlements and central bank liquidity. But here's the uncomfortable truth. If these holders begin to diversify, shifting into euros, gold, or even UN-denominated assets, it isn't a slow migration. It's a dumping cycle with real teeth. I remember being in Beijing last year, speaking with financial strategists who pointed out that China is actively exploring ways to reduce U.S. debt exposure without crashing their own reserves. That's a delicate balancing act, but it signals intent. Treasuries are no longer seen as untouchable. Here's what nobody tells you. These moves aren't reactive. They're preemptive. Countries want to hedge against the dollar's long-term dominance, and they're willing to do it gradually to avoid immediate market shocks. Let's quantify the risk. Assume just 5% of China's treasury holdings are sold or swapped annually. That's 43.5 billion of selling pressure every single year, just from one country. Scale this across multiple nations, and suddenly, billions that were considered risk-free collateral are vulnerable to political decisions, not market fundamentals. And in a highly leveraged system, even modest reallocations can trigger outsized price moves. Here's the paradox that should terrify investors. The weapon meant to create global financial stability, the dollar-denominated treasury, is also the weakness. Countries holding these assets can become both dependent and vulnerable, and any strategic shift can ripple through banks, hedge funds, and ETFs worldwide. This is why the narrative of safe U.S. debt is misleading. Now, add in the rising interest rates we discussed in Part 2. When combined with geopolitical diversification, the system is no longer just financially fragile, it's structurally exposed. If central banks simultaneously reduce treasury holdings while the Fed continues quantitative tightening, the market faces simultaneous supply shocks from multiple directions. That's how a safe asset turns toxic. Here's a case study. In late 2022, Saudi Arabia and the UAE quietly started reallocating a portion of their reserves into euros and gold. The amounts were modest, roughly $25 billion combined, but the market reaction was immediate. Treasury yields spiked, and global bond ETFs experienced temporary outflows. It was a small-scale warning, but it proves the mechanism works. The system is politically and strategically sensitive. Let's pause for a moment. Force 3, the geopolitical shift, doesn't just threaten treasury prices, it undermines the foundational assumption of U.S. financial hegemony. Most analysts think the US can print and the world will buy. But here's what's really happening. Buyers are becoming more selective, more strategic, and less predictable. That's an uncomfortable truth for anyone relying on treasuries as the ultimate safe bet. And the numbers back this up. In 2023, foreign net purchases of treasuries fell to $46 billion, the lowest in a decade. Contrast that with $1.2 trillion annual purchases a few years ago, and you start to see the scale of the shift. The global appetite for U.S. debt is real, but it's no longer automatic or guaranteed. So here's what matters for investors, policymakers, and strategists. Treasuries are no longer just financial instruments. They are geopolitical signals. Every shift in holdings sends ripples through global trade, currency markets, and even domestic policy. The three forces we've discussed, leverage and dependency, interest rate dynamics, and geopolitical reallocations, are converging. Stay with me, because in the final part, we're going to pull this together into a framework you can actually use to understand the dumping cycle, and I'll outline 3 potential scenarios for the future of treasury markets. You'll see exactly how investors, nations, and even ordinary savers could be affected if this convergence accelerates. And here's the cliffhanger. The forces are already in motion, and the choices made over the next 12-24 months will determine whether treasuries remain a safe asset or a toxic one that shocks the entire system. Let me show you how it all comes together. Now, let's pull this together and give you a framework to make sense of what's happening. I call it the treasury dumping cycle. It's the intersection of 3 forces: leverage and dependency, interest rate dynamics, and geopolitical reallocation. Individually, each force is concerning. Together, They create a system where the supposed safest assets in the world can suddenly become toxic under pressure. Force 1, leverage and dependency, sets the stage. Trillions of dollars in Treasury-backed loans and derivatives mean that even small sell-offs amplify across global markets. Force 2, interest rate dynamics, makes long-duration Treasuries highly sensitive to Fed actions, marking paper losses that quickly become real if leveraged entities need liquidity. Force 3, geopolitical reallocations, adds the wild card. Countries diversifying reserves based on strategic calculations rather than purely financial considerations. Here's what matters. This isn't theoretical. In total, over $10 trillion in Treasury holdings are exposed to at least one of these forces in a meaningful way. When these forces overlap, the market behaves in ways most models fail to predict. And this is exactly why mainstream narratives keep insisting Treasuries are risk-free. It's easier to maintain confidence than to confront fragility. Let me show you what this actually means for the average investor. Suppose global holders start reallocating just 2% of their holdings annually, while the Fed maintains higher rates to fight inflation. That seemingly small percentage translates into hundreds of billions in sales, pushing yields higher and prices lower. If leveraged positions are unwound in tandem, the result is a domino effect across ETFs, pension funds, and banks. This is why what was considered a safe asset becomes structurally dangerous. Here's the uncomfortable truth. You don't have to wait for a catastrophic collapse to feel the effects. Even moderate rate spikes or strategic reallocations can erode portfolio values, savings, and institutional liquidity. Most people think that treasuries buffer risk, but here's what's really happening. They concentrate risk in a different dimension: liquidity, leverage, and geopolitics. Now, let's outline 3 plausible scenarios for the treasury market over the next 12-24 months. Scenario 1, managed stability. The Fed carefully balances rates and foreign holders moderate their reallocation. Treasury yields fluctuate, but the system absorbs shocks. Losses occur in pockets, primarily leveraged ETFs, but nothing systemic. This is the best-case scenario, but it relies on near-perfect coordination and no surprises, rare in financial history. Scenario 2, gradual dumping cycle. Foreign holders accelerate diversification, leveraged positions unwind incrementally, and long-duration treasuries lose value steadily. This creates a sustained, multi-quarter erosion in prices, forcing institutional adjustments, higher borrowing costs, and market volatility. The safe haven narrative begins to break, even without a sudden crash. Scenario 3, flash shock collapse. A combination of rate spikes, leverage unwinds, and coordinated geopolitical reallocation triggers a rapid sell-off. Treasuries drop sharply, liquidity evaporates, and the ripple effects hit global markets. Banks, hedge funds, pension funds all experience acute stress. Emergency Fed interventions may stabilize prices temporarily, but confidence in U.S. debt takes a structural hit. This is the extreme, but it's not impossible given the convergence of forces we've discussed. If you've been following, here's what you need to remember. The Treasury market isn't just about rates or supply, it's about systemic interconnections that most analysts fail to account for. And that's exactly why conventional wisdom fails here. The dumping cycle is subtle until it's explosive, and by the time headlines scream, treasuries collapse, much of the damage is already done. So what can you do? First, recognize that safe doesn't mean invulnerable. Second, understand the interplay of leverage, rates, and geopolitics. It's a framework you can watch in real time. Third, diversify with awareness. Treasuries may remain part of your portfolio, but you need to consider liquidity, duration, and counterparty risk, not just yield. Finally, here's the key takeaway. The Treasury dumping cycle is not a conspiracy. It's a structural reality of a system stretched to its limits. And if you understand it before the market reacts, you gain insight that most investors, analysts, and even policymakers will only realize in hindsight. If you found this valuable, hit that like button. Comment below, which force do you think will trigger the first sell-off? I'll be reading every answer, and we'll discuss the likely scenarios in upcoming videos. Subscribe to stay ahead of the curve. because when the dumping cycle accelerates, knowledge is your best protection. And remember, the safest assets are only safe if you understand the forces shaping them. Treasuries may have been the cornerstone of global finance for decades, but today they're a cautionary tale of leverage, rates, and geopolitical strategy colliding. That's the real story, and now you know it.